Welcome back. So today, by popular demand, I'm going to talk about life insurance, how I use life insurance as an investment vehicle as well as an asset protection vehicle, and my thoughts on life insurance overall. I did try to get my life insurance license. I actually am licensed, but I never sold a policy because it just wasn't for me, right? So I did it more for my own self education, for me to be more aware about life insurance, the two different types, and the pros and cons of it. So hopefully I can kind of give some insight and give a well-rounded response to life insurance and how I use it and the three different types. So the three types that I'm going to go off of, and these are three types that I'm more aware of, right? So the first one is term life insurance. So this one's the easiest one, right? So term life insurance is you buy a policy. It's typically the cheapest one, and it might be like, let's just say for me, I got my term life insurance policy. The younger you are, the cheaper it is. If you're healthy, it's cheaper. So if you're older and you're not healthy, it's gonna be more expensive, right? Because it's more risk to the insurance company, so it's higher costs. Makes sense, right? So if you're young, you're healthy, uh, life insurance will be a bit cheaper, right? So the first one's term. So you might buy like a 30-year or a 20-year term policy, and you just pay whatever. For me, I think a $1 million term policy. I got this at around 29, I believe, and I pay about I think $50 a month, right? So for term, it's kind of like if something happens to you, a freak accident, your beneficiaries get paid out a lump sum. So this is really good if, like, let's just say you're a single income household. Let's just say it's a husband and a wife, and only one of you work. And to protect the family, it's probably good to get term life insurance so that if something happened to the breadwinner, the family's taken care of, and the money is tax free to the beneficiaries, right? So, like, if something were to happen, you just submit the death certificate and you get the money tax free. Some term life insurance, like the one I have, has living benefits, and they delineate what that is. So let's just say a living benefit is you had a heart attack, right? So if you have a heart attack, survival rates of heart attack is very good, right? So if, let's say, you have a heart attack and they allow you to take 50% of your policy to use today. So let's just say you had a $1 million policy, and let's say you had a heart attack, and then your term life insurance has living benefits. Then at that point, you just would submit your medical documentation that you had a heart attack, the procedure, and then you submit that to life insurance, and then they will basically send you a check for 50% of your term policy, whatever it's negotiated. So, for me, at the very minimum, um, I would say for asset protection, term life insurance is the cheapest one you can get. It's what most people have. Your job usually gives it to you. Like my hospital job, they give me term life insurance up to my salary. So let's just say you make 100,000, then you'll get $100,000 term life insurance for free. So most people have it, right? So it's the easiest one. But the downside of term is that, let's just say I got a policy at 30 and it lasts until 60, and if you pass away at 61, you paid all that money, but you get none of the benefit, right? So that's kind of the downside of it, of kind of like that term policy. So that's the first one, right? So this is the one that most people have. The second one is a type of whole life policy, and I'm gonna go through two different types of whole life policy. So whole life policies is something that you own, that you pay for your entire life, right? So how whole life works is, let's just say for me, I have a $1.5 million whole life policy. It's called an Index Universal Life Policy. But at a high level, what it is you pay this rate every month, and some of the money goes to pay for the cost of insurance, and then some of the money, whatever is left, gets invested into like indexes or like stocks or mutual funds, right? So for me, I have something called Index Universal Life Insurance, also named IUL, and I have it through Transamerica. I'm sure all of you have been approached by someone who works at WFG, or they're trying to sell you index life insurance, right? So for me, I bought it, and how it works is, so let's just say every month, so for your policy, you want to get insurance. You don't want to overinsure yourself. So like if for example you're only worth like $1,000, it may be hard to get like a $10 million life insurance policy, right? So it has to be very reasonable for like your assets that you own, right? So for me, I own a couple pieces of property, so it's easy for me to qualify for higher life insurance. So for me, I have a $1.5 million index universal life insurance, and what you do is When you get your quote, you want to ask for a quote for max funding that policy. So what a lot of people don't know about a whole life insurance is that there's a minimum required that you need to put into the policy to keep it active, just to cover the cost of insurance. But there's a maximum that you can put in where it starts to become like almost like an investment vehicle, right? So let me give you an example to break this down. And sorry, I'm tired today, so I apologize for not explaining things as well. But pretty much for me, for example, I have a $1.5 million policy, right? To keep this policy just open, I have to pay, I think, $900 a month. Let's just make it $1,000 for simplicity, right? So $1,000 a month is my bare minimum that I put into this policy just to keep it open, right? So if something happens to me, my beneficiaries get $1.5 million. Now, where Index Universal Life Insurance gets interesting is when you can max fund this policy and it starts to become an investment vehicle. So how the insurance company calculates it is, all right, what's the max that I can put into this life insurance policy without it being treated as an investment, and it becomes more tax favorable. So kind of the loophole that life insurance does is, so let's just say for my $1.5 million policy, the minimum to keep it open is $1,000, but I can calculate the max that I can fund this policy over 7 years. So let's just say the max for simplicity is $3,000 or $4,000. So if I max fund this life insurance policy $4,000 a month for 7 years, it has to be 7 years because that's what's written in the tax code, right? So if you want the tax advantage purpose of life insurance and how you invest, you have to max fund it over 7 years. So let me give you a stupid example. So let's just say the max you can fund the policy in 7 years is $700,000. So what happens is you put $100,000 every year for 7 years, and eventually your $700,000 bucket gets filled up, right? That's option one. Option two is you can maybe put $100,000 because your bucket has $700,000 that you can put in. So how you pay to fill up that bucket's up to you. You could literally minimally fund your life insurance policy, and then once year 7 hits, you can drop a large lump sum, right? Like that works if you have a large lump sum of money. If you don't, like me, then you just put in every month. But the concept is you only have $700,000 that you can max fund this policy, and so the bigger the death benefit, the bigger you can max fund it, right? So if let's just say for me, I have a $1.5 million policy, the most I can max fund it is $300,000. Somebody who has a $3 million policy can maybe put, I'll just make up a number, but maybe they can put in $600,000, right? So the more death benefit, the more the more money you can put in that pot to max fund it, right? So if you get that concept, so what you do is, going back to the prior example, if I'm max funding the policy, the minimum is $1,000, I'm putting in $4,000, right? And then at that point, so $1,000 goes to pay for the cost of insurance, all the fees. The remaining $3,000 gets invested into like index funds, right? That's why it's called Index Universal Life Insurance. And with Index Universal Life Insurance, they have funds like the S&P 500, the total stock market, international funds. So usually you pick a diversity, right? Usually for me, I personally do like maybe 60% S&P 500. Maybe I'll do like 30% international, and then I'll do like 10% in maybe a more conservative interest-bearing account, right? So you want to spread yourself out. And with Index Universal Life, what's interesting is they have a cap and a floor. So let's just say in this month, your stock portfolio, your index fund portfolio went up by 20%. But if your ceiling is 15%, you only get 15%. So the indexes made 20%, but the ceiling is 15%, you only get 15%. And there's also a floor. So let's just say the stock market that month dropped by 20%, you still get a 1% floor, right? So it's more conservative, right? Like, so your floor is 1%, your ceiling is 15%, right? So each Index Universal Life policy varies. So you just have to see what your floor is and what your max is. So what's nice about this is it's a little more conservative, right? Like, and the S&P 500, it averages roughly around 8 to 10%. So typically that floor and ceiling is okay. And like I said, this is a more conservative investment that's part of your bigger investment portfolio, right? So to me, I like it because that money, the whole purpose of whole life insurance investing, Index Universal Life, is your money grows there tax-free. And when you pull the money out, like a loan. So you're taking a loan against your life insurance policy, right? And then when you take a loan against your life insurance policy, you don't get taxed on it. So it's kind of like a tax-free wealth building vehicle, right? So the money you put in is your after-tax dollars. It will start to compound tax-free, and then once you max fund it, and it starts to grow, that's when you can start pulling out money as a loan, tax-free, to invest or live your life, right? And what a lot of people do is they'll take a loan against their life insurance, and they leverage it, right? So let's say it costs you 2% to access your life insurance money. You borrow out 2%, and let's say you're investing in some real estate, which is earning you 5%. So you're arbitraging at 3%, right? So that's indexed universal life insurance. So variable universal life insurance, which is the next policy I have, is very similar to indexed universal life, but there's no ceiling and there's no floor. So you ride the stock market, right? So if you go up 20%, you go up 20%. If you go down 20%, you go down 20%, right? So typically, variable universal life has fewer fees because you just ride the market up and down, right? Versus index universal life has more fees, but you have a little protection, right? You have a ceiling and then you have a floor, right? So I have both, right? So I have term life insurance, index universal life, and then variable universal life. And my goal is to max fund all of them, right? Like, from personal experience, do not buy life insurance unless you can max fund it. So if your max funding number is $1,000 a month, then get less benefit so that you can max fund it, right? So that's my suggestion. Whatever the life insurance agent gives you, it's usually the quote for the bare minimum. You don't want the bare minimum, right? You don't want the bare minimum. If you can only afford $1,000 a month, lower your death benefit and make sure that $1,000 is max funding it. And you can ask the insurance agent, like, hey, like, how much would it be to max fund this policy? So it's better to get less death benefit and max fund it, right? That's what I recommend. Personally, what I'm doing and what I recommend. And like I said, with life insurance, it's how a lot of the people build wealth. Me personally, I think that, let's say you're struggling paycheck to paycheck. I don't recommend whole life insurance yet. Maybe start off with some term, but once you build up some assets, once you have disposable income, then I would recommend max funding a index universal life insurance policy first. And then if you're more advanced, then you can maybe do a variable universal life, right? So like that's the sequence I would recommend. Term first, index universal life if you have disposable income, and then variable universal life, right? So that's the sequence that I would recommend. And for me, the bad rap about whole life insurance is that there's a lot of fees, right? So like if you look down, I'll do a video on it, but like there's so many fees. Like I think I did when I wrote it down in a blog, it's like 10 different fees. And honestly, life insurance is a terrible investment for the first 10 years. Because when you're max funding it the first 10 years, that's when the insurance companies charge the most fees, because that's the most risk for them, right? If you were to buy a policy and then get hit by a car the next day, they'll pay out the beneficiaries, right? So in the first 10 years, they're going to charge you a bunch of fees, right? But once you, after year 10 and the fees start to drop off, that's when the compounding really grows. That's why I said you have to think really long term of life insurance. Like you have to like invest in it your whole life. Like you just want to max fund it and then be done with it. So for me, I want to max fund my policies over 7 years. So roughly for my index universal life, that's around 300,000. For my variable universal life, that's roughly around 300,000, so $600,000 total. I just want to max fund it over 7 years, and then once I max fund it, you cannot put any additional money into it because it'd be considered at that point a modified endowment contract, so it loses its favorable tax status, right? So if you take advantage of it, you can't put too much money in it, then you have to stop, right? So for me, while I'm still active in W-2, it's a great time to max fund my whole life insurance policies. And then when I'm older and I don't want to work anymore, at that point I'm already max funding it, so I'm good, right? And let's just say I instead of max funding it, if I still have more money to invest, I can open additional life insurance policies to max fund, right? So overall, I will say life insurance is kind of the game of the wealthier, and depending on your situation, but I would say at the very least you should have at least a term policy. Like I said, your work probably gives you one for pretty cheap. And then as you start to build assets, like let's say you own a couple single family homes, you own an apartment complex, at that point maybe you should allocate some money towards index universal life policy. And if you're really more advanced, then you do variable universal life. For me, I think what I have is enough for my insurance, because it's just kind of safety. You don't want to go too crazy with it with insurance, and make sure that you're able to max fund it, right? So for me, I want to max fund my index universal life and my variable universal life. Once you're done, then I'll be free of that monthly payment obligation, and I'll let that tax-free compounding do its thing. So what's nice about the taking a loan against, let's just say my life insurance policy grew to like 3-4 million after compounding, and let's just say I took like a $2 million loan against it hypothetically. So it's worth 5 million. I have a $2 million loan. Something were to happen, at that point they'll just pay out 3 million to your beneficiaries, right? So some people think that life insurance is only for the beneficiaries, but you can still use the life insurance for yourself, right? Like I said, you can take a loan against it. So maybe when I'm like 60, 70, and the money compounded since I was like 27, I can take a loan against it, use it for myself. And then whenever I pass away, the money still goes to my beneficiaries tax free, right? So it's a way to grow money tax free. It's a way to pass off money to your beneficiaries tax free, and that income that you pull, because it's a loan against your life insurance policy, doesn't count as income, right? So you can technically live off of like your life insurance money loan that you pull out every month, and then pull it out tax free, and then live off that, and then to the when you file your tax returns, they don't consider you as having income, right? So that's kind of the tax advantage that people are taking care of. So I know I went through a lot. I know it's probably confusing. It took me a while to grasp it. I'm still learning it myself. But let me know if you have any questions about term life insurance, index universal life, variable universal life. I did a general overview, but happy to do a deep dive on one of my policies if you're interested in how I do it. But key message: you want to max fund it, right? Max fund that policy over 7 years, and it'll be a great, it'll be a great investment vehicle in your tool belt. Because for me, I view investing as like multiple tools, right? Like I do real estate, I have index funds, I have life insurance, I have businesses, I have a W-2, right? Like there's just many ways where you're building income, you're building wealth, you're building assets, right? So like for me, I'm not like, oh, you only do life insurance, you only do real estate. You want to have a nice architecture of assets and investments that make sense holistically, right? So you want to diversify a little bit to kind of hedge against ignorance, right? That's what I'm doing, for lack of a better word, right? Even though most of my net worth is in real estate, I want to diversify a little bit, to give me a little bit of protection, in case something happens in real estate. So once again, let me know if you have any questions down below. Hopefully this brought value to you, and hope to see you next one. Please share this video with somebody who can benefit or is thinking about investing in life insurance. Hope to see you next one. Thank you so much. Bye bye.